Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading report for September 27th, 2014. Market has shifted into bullish volatile conditions. On an annual basis, using weekly RSI 14, we are at 57 out of 100 in the higher end of neutral. On a 10-day basis, using the 10-day NDX, we're at 29 out of 100, so the low end of neutral. Looking at the market mosaic, price with respect to the 200-day moving average is at 5.20%, so that's 3.2% above sideways markets. That's red bullish, meaning it's been among the worst postures in the last 6 months. Slope of the 50-day moving average went to red bearish at 0.11. ADX is a weak trend at 14.4. When it crosses back above 15, we'll be alert to whether bulls or bears are in charge, and we'll be prepared to go in that direction. When it's that low, there's an opportunity for an intermediate term swing to unfold in one of those two directions. ATR percentage is volatile at 0.87%. The risk index is the 30-period moving average of the VIX divided by the 10. The threshold between risk on and risk off is 1.0. The current reading is at 0.94, so we are in risk off mode. When you take that score of 0.94, compare it to the last 5,000 trading days, and find the standard deviation, we can compute a z-score or a risk z of minus 0.85. Here you see a 90-day histogram of that indicator. We've moved from a minus 2 to a plus 1.5 z, and now down to almost minus 1, so we're at minus 0.85. When this turns, that will be a nice swing trade opportunity in XIV. In the meantime, this favors a day-by-day intraday trade in VXX to take advantage of local short-term volatility. In the blended monthly rebalancing, you can see the symbols that we've been holding since 1 September in the various portfolios. And then based on Friday's price action, these are the current leaders of the top 3 in each of these portfolios, and the leading candidates in the populations you see here: the Dow 30, ETF 200, and ETF Max. In ETF 2, the theoretical exposure is at 30%. Only 3 of the world's major indices are on buy positions, i.e. better than their 4-month moving average, and 7 are on cash position. The model portfolio itself is still at 70% exposed. Just a quick look at the components of the ETF 13 and 32 ETF portfolio. You see in the 13 it's technology, and then treasuries, Latin America, and then the large caps. More than half are in a cash position. In ETF 32, being dominated still by China, technology, healthcare, and tech, and treasuries. Again, more than half on a buy or on a cash signal. In ETF Max, we're looking at 1,300 or so ETFs. India and China remain on top. The ones I'm interested in are green and then white. So Middle East, dividend, and market vectors, biotech are outperforming dramatically on 3 months, but not on 6 months. So that may be earlier in the life cycle of growth. Egypt, S&P CTI, ETN, China, and so forth. This is the S&P 500 seen through the same lens and sorted by, again, the blended percentage. And again, we like the green and white, so Regeneron Pharmaceuticals would be of interest. And we're also showing the sectors that are that these symbols are members of. You'll see the domination by basic materials and healthcare, XLV. Next up is the World Market Health Check. The vertical blue lines are 10, 20, and 30 days worth of look back. This shows about 4 months total. The horizontal red lines are support levels that have held in the past, and which, when violated, become a series of profit targets on the way down the support ladder. When prices in this green zone are above the swing high, I have a bias towards being long quickly on the intraday trade. In yellow zone, in this case between the floodplain and a little north of the floodplain, I'm interested in seeing which direction the market is unfolding intraday before I go in that direction. And so you'll notice even in a bull market, you have some of these extraordinary one-day moves that are all signal, and so I want to be postured when we're in the yellow zone to go in either direction. In the red zone, in this case below 194, I would have an automatic bias to the south side. The blue channel is the 10-period regression line, the RAF regression channel, then is formed by the maximum excursion during the look back period, and so you see the 10 period is sloping down. The 30 period, lagged by a day, is this black channel, still sloping upward, but price is pushing the lower boundaries of that channel, and even broke through here for a moment. So that puts this upward move in jeopardy. The support level 198 really didn't hold, but we'll see this week just what's in store. Now, this sine wave looking line is the 30-period regression line slope. It's a time series, and the blue circles correspond to key turning points, like when it reaches an extreme reading. We know from stats that a downward slope of minus 0.22 is extremely steep down, and 0.4 is extremely steep up, and this dotted line represents the flat line, which we are approaching. When this slope value gets to this dotted line, then the 30-period slope is going to be flat, and we would think that the market is having rolled over. And so you can see the life cycle of that market slope in this sine wave with the key turning points shown in blue. When we get turning points here up at extreme locations, then the next 30 days become interesting. You'll notice here that it went from steep up to flat just before a collapse, and here it went from steep up to flat and perhaps a collapse. So we like to keep an eye on this intermediate time frame as an indicator towards general health. So if we do fail below the zero line here, if we just take the nearest neighbor technique, this sell, once it crosses zero line, this moved from 193.5 down to 189, about another 3% sell-off, and that would bring it down here to 192.5 or so. So we'll be watching carefully to see if this bottom of the floodplain holds, if this support at 195 holds, and preserves the upward move of the market. ETF2 regional report, 7 out of 10 are on a cash position, which puts us at 30% invested, 70% cash in the allocation model. The S&P at 81 is still better than the globals at 73, so the U.S. is favored over the globals. Inside the U.S., it's technology at 87, large caps SPY at 81, mid caps MDY at 76, and small caps in the yellow at 72. The two strongest sectors remain technology and then Latin America, and then the two weakest sectors are U.S. small caps and the European 350. Inside the U.S. sector spiders, technology and healthcare are continuing to dominate. The world market model, the mids and large caps in the U.S. are above average, technology exceptionally so, all the small caps are lagging. Japan is above average, Asia less Japan below average. Now you can see the leaders remain India, Thailand, Philippines, Vietnam. Latin American emerging markets are above average. Gold had a slight bump. It was red last week, but this whole cluster of commodities remains in the red. Silver is especially weak. Treasuries, bonds, U.S. real estate as alternate asset classes are above average. And you can see that in the business sector comparison, the tech and healthcare are dominating around the world, not just inside the U.S., but it's the U.S. as a lead or tied in all of the business sectors. So it is a broad-based favorable conditions for the U.S. ETF top 30, read that the same way as we do the BMR. Japan total dividend, pharmaceuticals, Japan hedged equity, healthcare. That's the XLVs of the world, and these are a little bit more volatile. But you can see XLV itself right here near the top. Looking at the Dow 30 through the same ETF2 lens, Intel remains at the top. Nike is showing some strength. DuPont, Procter & Gamble, Goldman, and Disney. DuPont has had some excellent trades this week. In the chat room, you can see those in retrospect. That's where the strength is. So Home Depot, Microsoft, Nike, Intel. I still like those on continuation patterns all day, every day for the rest of this week until we rerun the numbers. And just some liquidity stats for you. Looking at the daily report, MDY and EEM on overreactions, Latin American emerging markets on channeling, among others. We have quite a few large caps on channeling and overreaction. Silver 5 days down, 551Ws in both ETFs and the large caps, and got a lot to choose from down here on the auto framer stats. You can see how the trendiness has decayed, how volatility hit that quiet phase and is now just nudged into volatile. That has corresponded with this decay in the risk Z, and that's been nice one-day trades in VXX as we've gone along. Dow tactical summary, lots of channeling and overreactions to choose from, a couple triple screens, 3 551Ws, and half a dozen auto framers. Some fraud candidates highlighted in the green. Nike had a really strong day on Friday. You'll notice with the 10-day NDX at 337. That's maybe the highest I've ever seen. Amazing. Looking for some follow-through or a great recovery. So we'll look at Nike in the charts of interest. And then in the RSI2, we've got 2 firing on the green, 3M and Merck. ETF 30, tactical summary, enormous number of auto framers, a handful of FQNs. We have 1 RSI2, and that's coal. Brazil, Latin America, XIV all had great one-day turns. And closing new highs on the 10-day in Japan and treasuries. And again, lots of channeling and overreactions to choose from. The auto framers, you can see plenty to choose from here, and then their regression line fractal framework. These in the green are the symbols that are the most number of ATRs below their fair value expressed by the regression line 270. And then the symbols in the red down here are the ones that are the furthest number of ATRs above their own regression line 270. Just take a look at some historical stats here. Cliff has just been a terrific trade on the south side. It's getting punished in the basic commodities sector. Yes, I agree. Shh. All right, now let's take a look at the z-scores of 3 regression line slopes. This is been normalized by standard deviation, so the 90 period is in the red, has pulled back from extreme now in the upper half of its own little river. The 10 is below the line, and the 30 has made this nice sine wave move and is now back almost to parity. That's corresponded with prices pulling to the bottom of the river and the channel narrowing. That's a pretty good posture for, if we look back at nearest neighbors, the last time it was there was right in this area, and then it turned into a nice leg like this. A little harder to believe in here because we've had 45 days of decay, but this is the logical place for it to find support at the bottom of the river, and if that bull's going to continue to go. So we're in a critical state here. If it fails, we could get back here to 192 pretty easily and test this previous swing low. On the upside, we've got to get above that 201, 202 to get back into the green, and then we'd be off and running, and then we might see another choppy leg up like we saw here. So that's everything I want to cover for the executive summary of the trading reports. The girls are ready to go outside, Tala and Yoki, and then we're off to some soccer for tonight. So this is Ken Long from Tortoise Capital. Keep your risk measured and your powder dry. All right, girls, here we go.